Welcome to Valin Analytics webinar titled 3 Threats Affecting Commercial Insurance and What to Do About It. I'm Kirsten Marr, Vice President of Marketing for Valin. We'll begin by introducing our featured speaker. Brett Schroyer is an actuary and solutions architect for Valin Analytics. Brett uses his insurance industry and technical modeling experience to bridge the gap that sometimes exists between statistical modelers and P&C actuaries and underwriting managers. Brett joined Valin just earlier this year, bringing a breadth and depth of professional experience in actuarial analysis and financial modeling over his 20-year career as a P&C actuary and insurance professional. Prior to joining Valin, Brett served as Senior Vice President for Reinsurance for Willis Re in Minneapolis. Brett led Willis Re's predictive modeling practice and performed quantitative analysis and actuarial modeling in support of property and casualty reinsurance placements. Prior to this, Brett served in a variety of property and casualty insurance management roles, including actuarial and underwriting director positions at Travelers and as an actuarial consultant with Deloitte. Brett, I'm going to turn the reins over to you.
All right, thanks, Kirsten, and also turn over the slide presentation.
You got it.
All right, one more button and off we go to the races. Thanks for the introduction. I appreciate it. I'm excited to be here and talking today. Let's get started. I wanted to just briefly start out by saying this is an exciting time in insurance. Here at Valin, we're always looking for ways to help insurers improve their underwriting performance or results through data and analytics, and this year is not going to be any different. We last year had, in 2014, we had over 1,200 in-depth conversations with commercial lines executives about what keeps them up at night. This helps to give us a fresh and unique perspective that I hope that the participants in this conference are going to find valuable. We have opportunities today in data and analytics. We should not be satisfied managing our insurance business by looking at what's just happened and reacting to it. Instead, on the carrier side, we should be looking deeper into our customers' behaviors so that we can better predict or even influence what's going to happen. And that's what we're going to be talking about today. We're going to be focusing on 3 threats, and these were also the same threats we identified in our Commercial Lines Outlook report. We're going to look at adverse selection, what it is, how it can be recognized, and why adverse selection isn't necessarily a bad thing if you can be using it in your favor. We're going to talk about competitive pressure in the market. This is traditional competitive pressure, and these days it's all about underwriting results. How do you stay ahead, particularly now that there's so much more underwriting pressure in this low interest rate environment? And number 3, we'll talk about the market getting more crowded. There are some new entrants coming into the market. You looked out to see who might be knocking at your door. So we'll get started with adverse selection. It's kind of a strange term when you think about it, just those 2 words together. What does adverse selection really mean? We think of the underwriting function as fundamentally one of risk selection. The underwriter assesses the risk against the price they're able to charge and then decide whether or not to choose that risk. Well, in adverse selection, this gets turned upside down. It's the underwriter doesn't have all of the information that they need, and either the risk is aware of this or the competition is aware of it, and they wind up pushing that risk onto the underwriter without full knowledge. This is one example of a client that we worked with, and it's a classic example of adverse selection at work. In this example, we see from 2008 to 2009, there was a little bit of an uptick in the loss ratio, which caused the carrier to ask the question, what's causing this? Do we have a problem, or is this just part of a random walk? By 2010, the carrier clearly knew that there was something wrong. There was a big jump in results, and it wasn't just large losses coming through. It was across the board. So they sought out some help. They actually came to Valin, and we helped them to build a model to have better risk pricing and better underwriting selection. By 2011, results started to improve. And then finally, by 2012, we're right back where they started. So you could look at this as a success story. This company fixed their adverse selection problem, but what if this company had a way to detect adverse selection before it even started to make any impact? It is possible to detect adverse selection in real time rather than a year or 2 years after the fact. Companies that are able to do this are going to have a huge advantage in the market because they're going to be able to avoid these nasty swings of high loss ratio and low loss ratio years. It's great to be able to find and fix adverse selection, but it's far better to be able to detect it in real time and prevent it in the first place. I take that back. It's actually one step better to be ahead of adverse selection and use it as an offensive tool. With the right data and analytics, you can actually use adverse selection as a competitive weapon. Let's take Flo here. Look at that smile. There's a reason that she's smiling. In the chart to the right is the competitive rate tool. You can go on the web and you can get auto insurance quotes from Progressive and a bunch of other carriers, and they don't always have the lowest rate. In this case, they don't have the lowest rate. I had thought the first time I saw this that this was a marketing effort or a goodwill effort, but I realize now that this is actually very strategic. Progressive here, Flo, knows that this policy should be quoted at about $1,200. They have excellent knowledge of the market. They have great predictive analytics, and they also know what their competitors' rates are. On this particular policy, they know that MetLife is willing to write it for under $1,000. So what's Flo going to do? She's not going to lower the price and compete on it. Instead, she's going to tell you, hey, take your business to MetLife. They'll write it for $1,000, and she's handing MetLife a $200 loss on the policy. She knows that MetLife doesn't have the information that Progressive does, and she's using adverse selection against them. She's not worried about adverse selection at all. She's using it and wielding it as a tool. So here's the thing about adverse selection. It's here. It's in the market, and it's everywhere. There's a war that's being waged in insurance, and adverse selection is the weapon. Data and analytics are the ammo. If you're not actively engaged on the offense, then you're automatically on defense, even if you don't know that you're in the game. So how do you get started in this? How do you detect adverse selection early, and how do you go on the offensive? You need good data and good analytics. In particular, you need some forward-looking statistics so that you can measure risk and loss ratio before they begin to emerge. Here, in this chart, we're looking at loss ratio relativity and risk relativity. And when I use the term relativity, I just mean relative to a starting point. As you notice, both of these are starting at 1.0 at the beginning of 2013. So if the line's going up, that means things are getting more risky, or loss ratio is going up, and vice versa. If we track two statistics, our risk score and our loss ratio relativity, we have a leading indicator of adverse selection. Here's how it works. The blue line here is our risk score. This is our opinion of the relative riskiness of our business in aggregate. It's the business that we're writing month over month. This means that over the course of this year and a half, or almost 2 years that this chart runs, the business that we're writing is going to perform about 10% worse at the end than the business that we had at the beginning. This all by itself isn't necessarily a bad thing. It just means the risk quality is deteriorating. If we were reacting by pricing it appropriately, we could actually be making the same amount of profit on this business. But if we look at the second line, the orange line, we're seeing the predicted loss ratio relativity. What this is showing us is that at the end of the year and a half, we expect a loss ratio about 5% worse than where we started. This means that we're not reacting well with respect to price. We're not pricing all of that additional risk in. And these two statistics, these two trends taken together, are the leading indicator of adverse selection. If we can see this, we know what's really going on in the market, and we know that we have to do something to react to it. We took a look at data in our Valen Network database. This is a consortium of data that we have assembled over the last 10 years. we compiled some statistics on carriers' vulnerability to adverse selection. We looked at the company's actual policy pricing at the time they wrote the business versus the model indicated pricing based upon the best predictive model that we had in place. So we're not looking back at what the loss ratio should have or what the premium should have been based on the final loss ratio, but rather if we had had full information of all 4 million policies to build an accurate model, how should we have priced the policy? And then we did a sort of competitive analysis to see what happens if a competitor comes in and competes against target companies in our portfolio. What we found is that on average, carriers that would implement predictive analytics could achieve a loss ratio benefit of 8.8% on average. In best case scenario, they were achieving a loss ratio benefit of over 15% by employing predictive analytics to more accurately price policies, retain the good business, and to get more good business from the competition. Conversely, carriers who only reacted to competition by offering discounts to keep their good business, not increasing price on the other end of the scale, would see an increase in loss ratio of nearly 5%. That's the second line. So these are companies that are seeing competition because competitors have accurate pricing information, and they choose to compete against those competitors by retaining the good business, offering whatever discount they need to keep that good business. And then finally, at the bottom line, a carrier that is doing nothing, is just letting the market run roughshod over it, I guess, if it is losing the best business and having adverse selection and accepting some lower risk quality business. On average, those carriers had a 20% loss ratio differential, 20% loss ratio vulnerability. If this was a single company that we were looking at, let's imagine it's a $100 million company, then all these percents translate into millions of dollars. So this is a big issue. This is a big deal. And this is not just relative to work comp. This same sort of analysis can be done, and it applies to commercial auto, to business owners' policies, package policies, and so on. With the shift to near zero interest rates, the competitive landscape is changing. Companies can't rely on their investment portfolios anymore to be the primary source of income. They need underwriting profits. At the annual meeting of the Casualty Actuarial Society this year, Matt Mosher, SVP at AM Best, was commenting on data and analytics and competition. And he had a great comment that until 2008, the P&C industry as a whole, on the aggregate, had never written to an aggregate combined ratio under 100. So they were relying upon seeing an operating profit after their investment income. Since 2008, the P&C industry has done it every single year. Underwriting is king right now. And there are two ways to get an underwriting profit. You can select the best performing risks and go after that business, maybe discount your rate to win that business, targeting it. You can also go at the best at an underwriting profit by accurately pricing all your policies according to their risk. And then you're agnostic about whether you're winning things at the left side of the scale or the right side because you've got the right price out on everything. There's been a dramatic shift in market share in personal lines over the last few decades. The top 10 writers in personal lines now have 80% of the business. Commercial lines has remained better diversified, but it also has the potential for consolidation as the larger carriers using data and analytics are able to compete and absorb more market share. Commercial lines will always have a high degree of differentiation. There are niche markets where underwriting expertise is needed and where it exists. Data and analytics is leveling that playing field, however. Better modeling can give you the edge that you need to look outside of your wall and see profitable alternatives in new markets. However, those open windows work both ways. Your profitable niche may also now be visible to your competition. You can't fight this increase in transparency. It works both ways. And this train of transparency, data, and analytics has too much momentum to stop now. We hear from some of the clients that we talk to that They're very comfortable where they are. They have a niche market that they understand very well, and they've been writing it for 20, 30, 40 years. They have exceptional underwriting experience in that niche. They're profitable in that niche, and they have no need or wants to grow. And that's great. But what are you doing to protect your turf? With the transparency and with better data and analytics, the competition is now able to peer in and see a bit of what you're doing. And even if they can't compete against you head-to-head, what if they could come in and just take the best 10% of your business? This is the business that their modeling would tell them is so obviously better than everything else that it's worth their time to go after. They don't need to steal all of your business. Well, what happens if you lose the best 10% of your portfolio? For many companies, that would be catastrophic. That's where a majority of the profit comes from, is on the best small segment. There are two forces at work in competitive pricing and in data and analytics. There's risk identification, and then there's risk pricing, and they both have to be employed. If you remember when we looked at that leading indicator of adverse selection, we were looking at both of those statistics, knowing what the quality of the risk was and knowing whether or not the pricing was in parity with that shift in risk quality. The gray line that you look here represents a naive pricing scheme. On the left, we have highly profitable policies. On the right, we have the subsidized policies, so they're going to be higher risk. If we have a naive pricing strategy, we'll have the same price for every policy. That's the gray line. This company has two very distinct populations, and they're vulnerable to adverse selection. If a competitor comes in and offers differentiated pricing, the competitor will offer a lower price on the profitable policies and have a potential to steal that profit away from the incumbent. That's the green triangle. And they'll leave the incumbent with everything to the right, and they'll leave them with all that premium volume that needs subsidization without anything to subsidize it. That red triangle represents the adverse selection risk that the incumbent would face. Your biggest competitors in the market, if they're using data and analytics, they may have a playbook to come in and steal that best business. If you have the same playbook, if you have the same data and analytics, you could still wind up over-applying, I guess, that risk indication. Because if you are now writing, we're going to look at this red line that I've pasted over here, it's possible to have too much of a good thing. If we're being too aggressive on the good business, we may actually be pricing it under break even. So that red triangle on the lower left represents actually a loss that we're receiving on business, even though it's much better than average. We're just giving it too much credit. Conversely, it's also possible to make money on the high risk side. If we're pricing on the red line again, we're going to see some excess profits. You might think of that as non-standard business. So we're able to charge more, and yet we're able to retain that business. So we're able to win in the market because other competitors, other carriers in the market may not even be competing for it. So it's important to be able to select good risks, but it's equally important to be able to price on it. When we talk about risk quality, we often use a bin definition or a bin concept. The best risks go in bin 1. The worst risks go in bin 10. In this example, we have 10 bins. Most people would assume that if you ordered all of the risks up, so you've kind of got them rank ordered from best to worst, that you'd wind up with a roughly normally distributed population, a bell curve like this. You assume that most risks are average, and that a small percentage are going to be significantly better, bin 1, or significantly worse, bin 10. In reality, this is probably closer to an inverted bell curve, because if you think about it, you've got a bunch of policies that are going to be loss-free. That's going to be way over on the left. And then you've got a few policies that are going to have losses and are probably going to be loss ratios in the thousands. Those are going to be way in the right. So if we look at the actual loss ratio statistic at the end of the day, we wind up with an inverted bell curve. The challenge is to get a predictive model that flattens the curve. We want a model that distributes our policies more like this and puts more of the volume of policies at what we call the tips and the tails, bin 1, bin 10. This year, Valen released a new work comp model, risk model, that did something very much like this. It produced a better separation of high and low risk policies and really did flatten out that bell curve. We also included in this model revision for the first time a loss-free model. We leveraged data that we had in our consortium on over 2 million historically loss-free policies, and we're able to find ways of predicting which of those policies were more likely to have claims in the future. And we're able to separate those loss-free policies into various bins and get 30 loss ratio points of differential between them. So we're able to separate and find profitability even on loss-free policies. This, by the way, is where we're seeing a lot of carriers get really aggressive in commercial lines. They're starting to expand commercial lines writing, even traditional, regional carriers or the farm bureaus are doing this as well, but they're looking to write more of this Main Street business, they call it, and they're looking to write across the package, but they want to write small business and they really want to write loss-free. Well, it's a very crowded space. You're going to have a very good model if you want to be able to compete in that space and separate out the good stuff from the bad stuff and not experience adverse selection. Aside from traditional competition in the market, there's something new afoot in commercial lines. There are new entrants into the market. There's a lot of capital out there that's in search of a return, any return, and a lot of companies that are ready to bring their data and their analytics to bear. We've seen this in a big way in property reinsurance. The pension funds found themselves with billions of dollars of capital chasing any sort of return that they could, and they turned to property cat reinsurance as a new market. The funds found creative ways to deploy capital in this market, via cat bonds, for example, and they effectively doubled the availability of cat reinsurance in the entire market in just a couple of years. When the amount of supply doubles, of course, the rates come down, and the rates have stayed down. Traditional property cat underwriters now found themselves playing a long waiting game. The rules have changed in the market. Some would say that they're actually probably looking forward to a hurricane or two just to scare some of this new capital away. Commercial lines writers, are they at risk from this new capital entering the market? Let's look at a couple of examples of companies. You may look at this and say, what do these guys know about insurance? Well, you got Facebook. What do they know about their users? What do they know about the people using Facebook? Can you imagine buying a homeowner's or auto insurance policy from Facebook? This year, Facebook actually partnered with AXA Insurance in a move that they said to, quote, promote customer experience, excellence, and innovation. That doesn't sound very insurance-y, particularly the focus on the user experience, but this is Facebook's thing. They're about the user experience, not necessarily the security and the indemnity. They're not offering insurance yet, but could they be thinking about it? Overstock.com is coming into the insurance industry now, too, as an agency portal. Interestingly, in both commercial and in personal lines, you can log on to Overstock.com and you could buy workers' compensation insurance today. Overstock.com is changing the rules as well. Walmart is selling personal insurance the same way that it sells consumer goods, online and in bulk. Again, they're an aggregator. They've got an agency portal. Google, currently sitting on $70 billion in cash, recently purchased a UK quote aggregator, beatthatquote.com. They're reportedly looking to do the same here in the U.S. and are currently seeking regulatory approval to do that. We know that all these companies are already in the data and analytics business, and Google may be one of the leaders in that space. Think about what Google would know about us as policyholders. Earlier this year, Google bought Nest, which you may have heard, which is an internet-enabled thermostat and smoke detector company. It's a Wi-Fi thermostat and smoke detector. So now Google knows when you're home, it knows when you're at work, how often you're burning the bacon. They see when you're sleeping, and they know when you're awake. In all these examples, none of these companies are currently bearing risk as primary carriers yet. But don't think of this as limiting their impact. Don't discount them. It'll certainly be disruptive if they come into this market and start competing with traditional distribution mechanisms. Their target market, the market that they understand the best, are the millennials. And the millennials are the next generation of insurance buyers. Millennials are also currently the most dissatisfied demographic with current insurance products and services. So the industry has got to find a way to better meet their needs, or they'll be easily wooed by insurance offers from the technology and e-commerce companies that they already know and trust. Remember that primary writers have to maintain satisfaction among their policyholders and their agency plan. These firms don't have necessarily those same restrictions. They certainly don't have a loyalty to their agency plan. If they find a distribution mechanism that works and they think that they can get 1 or 2 points of margin in the insurance business, that would be huge. This 1 or 2 point margin for any of these companies is enormous. And they've got tens of billions of dollars in capital just laying around ready to deploy. They're not in insurance yet, but they're coming. I think it's just a matter of time. So what are we to do? We have to react. We have to change. We have to be innovative. The P&C insurance industry, however, is not renowned for its ability to be creative. It's a new world out there where the winners are emerging as those who understand the value of data and analytics, who are aggressively using them to maintain a competitive advantage. Innovation isn't mandatory, but neither is survival. Particularly in commercial lines, carriers see themselves as indispensable. They have a level of understanding and underwriting expertise that can't be replaced with mathematical models. That's probably true, but it's not necessary. If just 10% of their expertise can be replaced by mathematical models, it could be enough to put them out of business if firms like Google or Facebook or Walmart are footing the bill. So some key thoughts and where we think that things are going in 2015 is start looking toward the future. Start looking for real-time metrics on what's happening in your portfolio rather than relying upon the same metrics that you've always looked at, which is a loss ratio from last year or the year before. Know and understand adverse selection. Know that it's in the market and you're either using it offensively, you're defending against it, or you're completely unaware that it's going on, but it's there. Prepare for some more competition, especially from new directions and maybe even from outside of the insurance industry. Phil Gussman at Property Casualty 360 gave us that last quote. We should not be asking how to bring technology in to help run our business, but instead we should be looking at how is technology going to reshape my business, or how has it already reshaped my business. We can ask ourselves, what am I going to do differently? Where do we go from here? Businesses aren't reshaped overnight. So what can we do right now? Well, we have a number of tools that we use at Valen when we talk with our new clients. One of them is the organizational readiness checklist. It's going to help you get started on some conversations internally to see where you are on the data and analytics spectrum and what you might be looking at if you want to take your team to the next level. Bring this checklist to your team and see what sorts of conversations come of it. Are you ready to start moving toward a data-driven decision-making culture? We've also got a lot of resources. We write about this weekly on our blog, and we post those to LinkedIn, so you can follow us there. We will send an email to you after this recording with a link to that materials. Secondly, you've got to start learning more about what you insure. This is the way to protect yourselves against adverse selection. If you know your market better than your competition, you're going to find yourselves in the winning seat. That might seem obvious, but ask yourself if it's possible that a competitor could know more about your risks than you do, and base your decisions there. And finally, I'd like to encourage you to just start. You don't have to invest multiple years or millions of dollars to do any of this. There's going to be some really easy wins and some low-hanging fruit that you can start with. Go out and snatch these up, and soon you'll find that technological innovation in insurance doesn't have to be an oxymoron. This is possible. You can do this, and we are here to help.
Thank you, Brett. So now it is time for Q&A. So if you want to go ahead and type your questions into the question box that is on the right side of your screen, we'll give everyone just a couple of minutes to go ahead and put their questions in, and then we'll start Q&A. We have a couple questions coming in, so I'll just give everyone one more minute and then we'll get started. Okay, Brett, we have our first question here, which is, what are some of the good sources of data to be used from a multivariate perspective in predicting the future? Seems to be a little hype, but occasionally some variables do stick.
It seems to be a little, what was the word, hype?
A little bit of hype, but occasionally some variables do stick.
Yeah, that's a challenging question, and we could probably have a whole seminar based on just that. And in fact, companies have their whole business model based on that. What we have found, here's a hint, and something that we have found to be very productive is looking at some of the key indicators as relativities rather than as absolutes. So when we're looking at building the models that we have to predict auto losses or work comp losses, of course, we're looking at things like the class and the region and some demographic information. But if you're looking at claim frequency or claim severity, start looking at the claim frequency in a region relative to a claim frequency in another region, or a claim frequency for a class relative to claim frequency for other classes in that hazard group. There's a lot of power in looking at some of these relativities and giving us some more predictive power that aren't present in the rate plan. And looking at the experience that a carrier may have because of its particular underwriting appetite, its market segment, its geographic niche, it may actually have a different sort of experience than the rate plan would have. And by looking at some of those relativities on frequency, severity, you wind up picking up a lot of signal. Another important thing to look at, I mentioned this briefly just a second ago, is demographics. Things like Bureau of Labor Statistics, census data, weather data, crime data. These are freely available, publicly available data sources that you can link in and, again, start building some relativities on the business that you write. And we certainly use that information, too, in building our model.
Great. Thanks, Brett. The next question is a little bit about the metrics that we are using. What are the forward-looking metrics we're using to look at risk quality and the potential for adverse selection?
Well, we did go over that in the slide. The two key metrics I think to look at are the risk quality, the average risk quality for business being written. That number in itself is tied then back to a loss prediction. So each and every policy that's being written has a predicted amount of loss on it for the prospective policy term. And when it's written, on the day that it's written, we have an initial expectation of what the loss ratio is going to be on that policy. We've already predicted the loss, and now we've gone ahead and bound the policy so we know what the premium is. That gives us a loss ratio estimate. Taking that and tearing it apart into its two pieces, is one being the pure risk quality, so the loss relative to exposure, and the other being the final loss ratio as priced, which incorporates our pricing decision. We now have forward-looking indicators to tell us how our average risk quality is moving and how our future loss ratio is moving. You also want to be looking at things like your bind to quote rate by risk quality. So if we had that bin view where we have bins 1 through 10, look at how much of bin 1 if it's a renewal policy, how much of our renewal book are we declining if it's bin 1? Hopefully that's a very small number. How much of our renewal book are we declining if it's coming up bin 10? Hopefully that's a much larger number. And then we also want to know that when we do quote on bin 1 business, we want to see a very high bind to quote ratio. We want to see a high win rate. And maybe we want to see a much lower win rate over there in bin 10. We could be quoting on that business if we think that we can get enough premium for it, but like Flo's example, that could have been a relatively poor risk. Flo threw out a high quote and didn't get the business, but that really doesn't bother her because it was a bin 10 risk. She put out a high quote. She would have made money at that rate, but somebody else took it for less, and that's a win.
So, Brett, I have a question that's sort of on the other end of it, which is if you're not using analytics and underwriting today, are there some early warning signs that could point to whether we likely have an adverse selection problem?
Yes. If you are looking at your loss ratio and seeing that your loss ratio is moving in the wrong direction, your loss ratio is moving up, and you have no explanation why, that's a clear sign. If you are seeing that you've taken some rate increases recently, but those rate increases haven't translated into lower loss ratios, or at least not to the extent that you'd hoped. So you take a 5% loss, or you take a 5% rate hike to bring your loss ratio back in line, and you wind up seeing only 2 points of benefit from that. That's another clear indicator of adverse selection. If you're not using modeling, though, it's really hard to see because you just got one piece of the puzzle. All you're seeing is the final loss ratio. You're not seeing the risk quality piece of it. So the final thing that you could be doing is looking at doing a demographic survey of your book and look at whether or not you're seeing a shift in your book. So let's say you're writing personal auto. Start looking at is your symbol distribution changing year over year? Is your age of driver changing? Is your number of multi-car households changing? And if those things are shifting in ways that are intuitive to you that, oh yeah, we're going toward a higher risk on average because we've now got more younger drivers than we used to, that's a clear indication that a competitor has found a hole in your rate plan and you wind up taking more of that high-risk business on without really realizing that that's what's happening.
Great, thanks. We just have a couple more questions. If anyone wants to add another question, we do have a little bit of time, so go ahead and put that in the question box. But how does the carrier prove analytics is driving improved performance versus other initiatives that might be going on, like new underwriting guidelines or rate changes?
Well, I'll take this back to the same exhibit again where we looked at the two lines. One is the risk quality, and the other is the forward-looking loss ratio expectation. If our risk, let's say our risk quality were actually flat, so nothing is shifting in the book, we're maintaining neutrality, we're not doing anything to our rates, and our underwriters are pricing the same as they always have. We'll see two flat lines there. The risk quality is flat, and the predicted loss ratio relativity, or the loss ratio change, is also flat. If we're seeing a benefit in actual results, then that's going to point to something else going on. It could be better claim handling. It could be, what else could it be? It could be a shift in the market. We've seen shifts in frequency and severity just at the industry level that's impacting loss ratio. So those are things that are extrinsic to the risk selection or risk pricing process. And you can certainly build models that look at those processes as well and try to isolate out what the impact of those are. If you have an effort to write better quality risks, and you say you want that blue line to be decreasing by 5%, you expect your loss ratio to improve by 5% as well. And if that's where the actual results come in, you can fairly confidently hang your hat on that. If you get 10 points of benefit, you know that, well, gee, only 5% of it is because we're better at underwriting. Where did the other 5% come from? The key message here is that without having that measure in place, you never really know what was driving your results improving or decreasing.
Great, and we have one final question today, and it goes back to what you were saying in terms of analytics, making everything more transparent and basically kind of leveling the competitive playing field. And the question is, how do you protect your market niche expertise and continue to differentiate in the marketplace?
It's going to get much more difficult. You're going to see a lot more competition for the easy wins in competitors' books. You might have a company that specializes in fruit growers or specializes in road paving crews, and that, some of that takes some expertise in underwriting. You've got to understand that market really well. But there's going to be pieces of that that are obviously better performing, and your competition is going to find that. The way to stay competitive is you have to stay a step ahead of the competition. It's fine that the competition is able to identify the best part of your book. You just have to identify the best part of your book first. You have to be able to stay competitive on that. You may also find that you need to start looking to be a bit more flexible in your underwriting box. That you know that you have a niche and you're very successful in it. You might want to start finding areas of opportunity that are adjacent to your current markets where you can go out and find those quick hits, the low-hanging fruit, the best 10% of your competition's business to round out your portfolio a bit without going too far afield and completely outside of your area of expertise. But I guess it's simple, and I hope I'm not being glib in saying it, that data and analytics is going to affect your ability to compete in this market. And if you're not using it, and a competitor is, they will find and take the best parts of your business away. So you have to compete at the same level.
Great. Thank you, Brett. This has been very valuable information on today's web seminar. Also, thank you to all of our attendees for taking your time to participate tomorrow. Please look for an email from Valen with a link to the recording, the checklist that Brett mentioned that can help drive some internal conversations and priorities and next steps in your own organizations. And we look forward to continuing the conversation with you all. Thank you.
Thank you.